at really actually more on the Fed minutes right now, what they really mean for the fixed income markets. For that, we have Tom Tucci. He's head of U.S. Treasury trading at RBC Capital Markets. And Rich is going to stay with us as well. Tom, great to have you here on Street Smart. So let's start with those FOMC meetings. Anything that kind of caught your attention that traders on the floor there that they noticed here when those notes were released?
Well, I think there's a couple things to identify. There's a spectrum in which the Fed governors want to remove that accommodation. It won't just be strict asset sales. And the bottom line is their base case is they want the economy to improve and be self-sustaining before they make any such move. So the timing of this is still a question mark. I mean, when we take a look at this, they're talking about using these reverse repo agreements, which would be draining some liquidity from the system sometime in the next year. But there's still no finite date on it. The bottom line is the chairman would like some of this stuff to roll off on its own. If you remember, when they made the purchases, they bought securities from 2 years out to 30 years. So some of that stuff will roll off on its own by itself. They won't have to remove any of that. It'll just come out of the market on its own. We don't think that they're interested in selling any assets outright. The only way they would do that is if the economy was completely overheated, and we're so far away from that, I don't think that's a concern at this point. The reality of it is, how will they remove it doing reverse repo agreements with primary dealers and other money market accounts to remove some of that liquidity when they feel the economy has been self-sustaining, and probably for a couple of quarters. So the timing on this to us is still in the back half of this year, probably closer to year end.
Right.
But the reality of it is the market has to start to adjust for that. And I do think the other point that you'd made about the mortgage-backed security program ending at the end of March is kind of a critical one. We see globally investors are waiting for that to come and pass. They're underweighted mortgage-backed securities because they are expecting a widening to take place just because of the supply dynamic that will take place after March 31st. The reality of that is that it will all come down to what the shape of the economy is at that time. Because if people feel that we're moving into a decline in the second half of the year, interest rates really aren't going to back up that much, and people will be back in buying those securities. So it really comes down to how much momentum do you think the economy has? How far will it sustain itself?
Right. So Tom, the timing issue is still greatly in question here, no doubt about that.
Absolutely, because the yield curve would have shifted dramatically if they thought there was something imminent going on. I think this is the Fed being very transparent. They want to lay out the framework. They want to have the flexibility to act when they feel it's time. You mentioned capacity utilization. There's a huge amount of slack in that. I think the definition that we're trying to look for here is just kind of normalizing rates, not moving into a restrictive stance. Remember, they've been at zero interest rates for quite some time, and I think what's happening is if the economy can maintain some momentum over the course of the next couple of quarters, they'll want to get off that zero interest rate policy.
Well, Tom, my question regards the mortgage-backed industry, or the market rather. How high can that 30-year go, that benchmark 30-year go, if fixed rate mortgage, that is, if and when the Fed does? And do you think that the Fed would reiterate the program and continue buying them after March 31st?
And Tom, we just got about 20 seconds here.
Sure, that's definitely a possibility, and they've mentioned it in the past that they will consider and take a look at what happens to the market afterwards. Also, you have to remember there's some things that have happened with Fannie Mae and Freddie Mac where people anticipate that they will actually be the buyers of mortgages when the government steps out of the way. So there are still some backstops that I think will be in place after that program ends.